Bismillahirrahmanirrahim. Today's topic is capital expenditure versus revenue expenditure. So my name is Afzal Shad. I am the teacher for accounting and business studies for O and A levels. Let's start the topic. Today we will discuss about capital expenditure, revenue expenditure. Then we'll try to distinguish between the capital expenditure and revenue expenditure. Then we'll discuss about expenditure as a mixture of capital expenditure and revenue expenditure. So there will be one expenditure statement in which we will try to find out the capital expenditures and the revenue expenditures. Then we'll discuss about the wrong treatment of capital and revenue expenditure and their effects on the financial statements, just like income statement and statement of financial position. Then after this, we'll come to the second section of this lecture that will be related to the capital receipt and the revenue receipt. Then we'll try to distinguish between the capital receipt and revenue receipt, and then at the end we will segregate the capital receipt and revenue receipt from a single receipt statement. So let's start. Capital expenditure. So when a business buy non-current asset or adds to the value of existing non-current asset, it is called as capital expenditure. Giving you an example, whenever business is buying any fixed asset or non-current asset or making any addition to that fixed asset or non-current asset is called as a capital expenditure. Giving an example, buying the asset and bringing it into the business. Let's suppose we are buying a machinery worth of $1,000. So if that $1,000 worth of machinery is bought, that expenditure is called as capital expenditure and that machinery is treated as an asset. Okay, so second statement is when we are buying that machinery, we have to bring that machinery in to the factory. So what happens is we pay the carriage inward costs. So when we are paying the carriage inward cost, this cost is related to buying of an asset and is actually we are trying to actually install that asset into our premises. So that cost to bringing in the machinery into our office, into our warehouse or into our factory is also known as capital expenditure. So the cost of factory, the cost for machinery was 1,000 and the cost of bringing in the machinery was, let's suppose, $100. So now the total cost for the machinery will be $1,100. Now we want to install that machinery and we have to spend additional $50 in order to make that machinery run and make the machinery operative for the business. So this way we are spending additional $50 in order to start that machinery. That $50 is going to be the part of the running of the machinery. That means this 50 is going to be added to the cost of machinery itself. So now the total expenditure until the machinery is in an operative state in our company, all of the expenses including the cost of the machinery, including the cost of carriage in and installation of that machinery, all of these three combined together will become the capital expenditure. So cost of the machinery was 1,000, 100 was the carriage in and 50 was the installation cost. So total cost for the machinery will be 1,150 in this case, and all of this amount of 1,150 will be termed as capital expenditure and will be added to the cost of the machinery. Now any associated legal cost in order to buy that machinery, the paperwork desired, we open the letter of credit if we are buying the machinery from overseas. So all of the legal cost associated with this buying of the machinery will also be included in the capital expenditure. Carriage inwards, it is already discussed. Then any cost needed to ready the asset for use, to make the asset in a running condition, operative, unboxing, assembling the machinery, all of that cost will be added to the capital expenditure. And then at the last, given in another example, let's suppose we have bought a new building and we are trying to paint that building for the first time. This was a semi-manufactured building, or this wasn't painted. So first time when we buy that building and get it painted, that means that painting is going to be the capital expenditure, because that paint is making the building operative for us. So let us move to the next part. It will become clearer when we will discuss about the revenue expenditure, but let's, for till this point, till these slides, when we are talking about the capital expenditure, you just try to understand all of the things which are related to buying the asset or bringing in the asset into the company. Then we talk about the revenue expenditure, all of the expenditure incurred on running the business on day-to-day business operations. So the running cost, in short, is called as the revenue expenditure. What is the running cost? Day-to-day expenses of the business: wages, salaries, we sell inventory on day-to-day basis, we repair an asset every second month, then we insurance and finance cost of any item or any product, that will be included in the revenue expenditure. So the difference between capital and revenue expenditure till this point is, capital expenditure is the cost which we are bearing on buying the asset and bringing in that asset into the factory. Second thing is the revenue expenditure, that is related to day-to-day operations, the general cost which is not related to buying of the non-current assets. So in these examples you will not see any buying of or first time making it usable or improvising an asset. You will not see that thing over there. We just mentioned one thing over there, that was a repair of an asset. Repair of an asset never adds the value to an asset. That means it is repairing of an asset is always termed as revenue expenditure. Capital expenditures, further example, we'll discuss about the capital expenditure and revenue expenditure in detail now. Let's suppose the carriage expenditure on bringing in the machinery, this was already discussed in the under the heading of capital expenditure in initial slides, that when you are paying any carriage inwards in order to bring that machinery in, that will be related as capital expenditure. New wiring to provide power to the machinery. So you are bringing in the machinery and you are trying to make it work, trying to make it operative in the organization or the factory. That is, you are doing the wiring for the first time, or we can say assembling the machine for the first time. This cost is related to make the machine operative. That is also called as capital expenditure. Amount spent towards the demolition of the property to construct a new property at the same place. So if you're trying to construct a new building, obviously a building is a non-current asset, it's a fixed asset. So when you are trying to build a factory or a building, you have to demolish the previous one. So demolishing the previous one in order to make a new building workable, operative, this will be termed as capital expenditure. Then architect fee for the property design. So whenever you are constructing a building for the first time, if you are paying an architect fee, that is also going to be in the capital expenditure. Then testing costs incurred to test the newly bought equipment. So testing costs which you are incurring in order to test the newly bought equipment, that means you are buying the new equipment and you want to test that first. So all of the testing costs, the first time running cost, is going to be the part of capital expenditure. And amounts spent to acquire non-current assets, that means if you are acquiring all of the expenses related to acquiring of the non-current assets or making it operative. So cut the story short, capital expenditure in one sentence, we can say buying of an asset, bringing in asset into our company, making it operative, or improvising an asset. These four things are called as capital expenditure. I repeat, buying the asset, bringing in the asset to the factory, making it operative, and last is improvising the asset, improving, installing new additional thing into an asset, like you install a 300 GB of hard drive in your computer or laptop. This is an improvisation. You improved the value of an asset. So if you are improving the value of an asset, that will also be called as capital expenditure. So let us see some further examples of the revenue expenditure. Carriage on purchase returns. Okay, so you purchased an asset, you were calling it as a capital expenditure. But now here we are talking about the purchase as a return. It is not related to the return of that asset, but it is related to the returns of the goods or inventory. That is called as purchase returns. So carriage on any other thing, on goods or inventory, or return of that inventory is related to the revenue expenditure. So examiner sometimes tries to confuse us with the purchases returns, and we start thinking that purchase return is something like we are returning the asset. When you are returning the asset, you don't call it purchase returns, and when you are buying the asset, you don't call it purchases, because these are the goods that are associated with the goods or inventory only. That means it is going to be the part of inventory, and inventory is not the non-current asset, it is the current asset. So it is not going to be the part of capital expenditure but the revenue expenditure. So any cost related to the inventory is going to be the revenue expenditure. Next is legal cost incurred to collect the debts from trade receivables. Trade receivables are not the non-current assets. So any cost related to the current assets is not going to be the capital expenditure but the revenue expenditure. Repairs to build business property. Repairs and maintenance is the part of revenue expenditure. In simple words, redecoration of business premises to celebrate May Day. So you are redecorating. You are not decorating for the first time. You are not improvising the building for the first time. You are not painting the building for the first time. So if you are not painting it for the first time, that means it is a repairs, and repair is a part of revenue expenditure. Replacement of electricity bulbs in the factory. So you keep on doing that again and again, and you keep on replacing the bulbs, and by replacing the bulbs, you are not adding value to the factory. Like the cost of the factory won't be increased if you say that I have installed 50 bulbs in it. So replacement of electric bulbs comes under the repairs and maintenance, and repair and maintenance is the revenue expenditure. Repainting of a building in use for 5 years. So the building was in use for 5 years and you are now repainting it. In initial examples of capital expenditure, we said painting the building for the first time. So painting the building for the first time is capital expenditure. But repainting a building after it is used for like few years, it is going to be the revenue expenditure because it comes under repairs and maintenance. Important points to remember about the capital expenditure is capital expenditure enhances the value of non-current assets and subsequently total assets value. So first thing to remember is we have discussed the 4 points agenda in capital expenditure: buying of an asset, bringing in the asset into the factory, installation or making the asset operative, and the last one was improvising the asset. So first point is related to the improvisation of the asset, that is, which enhances the value of non-current assets, improvise the value of the non-current asset. Second important point is capital expenditure does not repeatedly occur in the same financial year. So the thing which is related to the capital expenditure is it normally never occurs every second, third month. So all of the examples you discussed in the capital expenditure, like painting the building for the first time, it is not going to happen every second or third month or even in a complete financial year. So that does not repeatedly occur. So this is going to be a helping point for you in order to distinguish between the capital expenditure and revenue expenditure. Then last one is capital expenditure appears in the statement of financial position of the business as a non-current asset. So capital expenditure, as stated, it is going to be the part of non-current asset or a fixed asset. Important points to remember about the revenue expenditure. Revenue expenditure increases the value of total expenses. I repeat, it increases the value of expenses, not the assets. Capital expenditure was something which was increasing the value of assets. Revenue expenditure is increasing the value of expenses. So hence it reduces the profits for the year. So it is going to reduce your profit for the year. Then the benefit received from the revenue expenditure gets used up in the same accounting year. So all of the expenses which you are incurring, like salaries, repairs, are mostly going to be used within that year. But the capital expenditure, buying of a machinery, the machinery is going to be utilized for more than 5 or 10 years. So that means it is a capital expenditure. But for the revenue expenditure, normally it has been used for the same accounting year. Revenue expenditure is of recurring nature, that will it keep on repeating. Give you an example of salaries. So salaries is going to be repeated 12 times in an accounting year. Revenue expenditure appears in income statement. As we said, that revenue expenditure is part of an expense, whereas capital expenditure is part of an asset, non-current asset. So application of matching concept, over here we can see that revenue expenditure, the examiner may ask you about which concept is applied over there when we are doing the revenue expenses. So related to the revenue expenditure, most of the times we can say that we are applying the matching concept, which states that revenue expenses are matched with the revenues of the same period of income statement. So you are trying to match the expenses of the same accounting year with the expenditure which has been actually incurred. So let's close this thing, a quick differentiation summary between the capital and revenue expenditure, so that you are able to distinguish between these two. First important element is the amount spent to buy a non-current asset. In capital expenditure, the major portion of the amount is towards buying of a non-current asset, buying of a machinery, buying of a building. So it's a big cost. But in revenue expenditure, the amount spent to meet the day-to-day running costs. So it is related to the running costs. In capital expenditure, the amount spent is normally high. You are going to buy a machinery, you are going to buy a car, you are going to buy a building. So the cost incurred on that is eventually high. But the cost, the amount spent on revenue expenditure, like paying the salaries, is eventually lower than that of the buying of an asset. Third point is it gives benefits to the business for an extended period of time. So as we said, if you are buying a non-current asset, it is going to extend, the utilization of that asset is going to extend for more than 1 year. Like machinery is going to be used for 5 or 10 years. A building can be used for more than 10 years. But if you're talking about the revenue expenditure, just like the salaries, the benefits received from the revenue expenditure by the business usually consumed in the same accounting year. So if you're paying the salaries, if you're doing the repairs and maintenance, that is going to be utilized, most of it is going to be utilized in the same accounting year. Fourth point, it is a non-recurring expenditure. Normally you will not see a capital expenditure buying of an asset. You do not buy an asset every year, every second or third month. But the revenue expenditure, just like the salary, you keep on paying them 12 times a year. It is a recurring expense. And the last point is the capital expenditure is the part of statement of financial position. How? Because capital expenditure is related to the non-current asset, and non-current asset is the part of statement of financial position, whereas revenue expenditure is shown in the income statement. Revenue expenditure is the part of expenditure, indirect expenses, and that is indirect expenses the part of financial statement. So before closing, let me tell you that you do not need to confuse the word expenditure with the capital. Just simply believe or develop a concept just like this, that capital expenditure is kind of a non-current asset expenditure, and revenue expenditure is kind of an indirect expense expenditure. So by that way you will be able to distinguish between the capital expenditure and the revenue expenditure, and we have discussed a lot of examples. If you are still confused at this point, you can restart this video and re-watch it for once more, so that you are able to understand the differences. And if still you feel like you are confused, you can comment on this video, or you can contact me anytime on my website. Let's do a practice example to distinguish between the capital expenditure and the revenue expenditure. First is buying a van. What do you think it should be? A capital expenditure or revenue expenditure? First thing, that buying a van is a non-current asset or an indirect expense. Van is a non-current asset, and non-current asset is related to capital expenditure. Second, petrol costs for van. The cost of petrol, is it an indirect expense or it is a fixed asset. Petrol costs. So petrol cost is an indirect expense. So if it is an indirect expense, that is going to be treated as revenue expenditure. Third is repairs to a van. Repairs and maintenance, as we have discussed, that repairs and maintenance is the part of revenue expenditure. So repairs to the van is going to be the part of revenue expenditure. Putting extra headlights on a van. Now you have to distinguish between repairing and putting an extra headlights. By putting in extra headlights, you are trying to improvise the value of a van. You try to improvise the utilization of a van. So now putting in extra headlight is kind of an improvisation or improving the value of an asset. So putting extra headlight on a van is going to be the part of capital expenditure, non-current asset. Buying machinery, it is simple. Machinery is a non-current asset. When you are buying it, it is related to the capital expenditure. Electricity costs of using machinery. Electricity cost is normally treated as indirect expense. So the cost of electricity you keep on it reoccurs every month. You pay bill every month. So by that way, it is going to be a revenue expenditure. And electricity cost is also termed as indirect expense. That is why it is going to be revenue expenditure again. Now, seventh point is important. We spent 1500 on machinery. Out of that 1500, 1000 was for an item improvement added to the machine and 500 for the repairs. So there may be some terms which may tell you about there will be a one part of that expense that will related to the improvement of an asset and another part of the expense that is related to the repairs and maintenance. So we have to split that in two parts, and we have to split out and we have to relate the capital expenditure with the improvement. The improvement is going to be related to the capital expenditure and the repair is going to be related to the revenue expenditure. We will discuss this seventh point in detail, but right now 1000, which is related to the improvement, and as we discussed that the improvement is related to the capital expenditure, so it is going to be the part of capital expenditure. 1000 will be the part of capital expenditure. 500 were repair and maintenance, and repairs and maintenance was the part of revenue expenditure. So we can say 1000 will come under the capital expenditure, 500 will come under the revenue expenditure. Eighth is painting outside of a new building. New building, that means you are improvising the value, or you are trying to make it workable or operative. So by that way, it is going to be part of capital expenditure. And ninth point is 3 years later, repainting the same building. So now you are repainting the building. So repainting is going to be the revenue expenditure. So improvising the asset or making it workable for the first time, capital. After that, it will come under the repair and maintenance, revenue expenditure. Okay, so now let's discuss the seventh point in detail. When we were spending like 1500, and out of that 1500, 1000 was the part of capital expenditure and 500 was the part of revenue expenditure. Now see where it is going. 1000, which is the part of capital expenditure, is going to be added to the cost of machinery. It is going to the machinery account, and then that machinery account is the part of statement of financial position. That means it's going to be added to the existing value of the machinery. So in the start, I gave you an example of buying a machinery of 1000, and the installation cost on that machinery was 100, or carriage in cost for that machinery was 100. That 100 was added to the price of the machinery. Similarly, over there, if we have bought a machinery worth of 10,000 and 1000 was spent on improvisation, that means now the total cost is 10,000 plus 1000, 11,000, and this 1000 is going to be added to the cost of machinery, and machinery is available in the statement of financial position. That means it is going to be the part of statement of financial position. Now let's discuss about the 500 revenue expenditure, repairs and maintenance. So repair and maintenance is the part of income statement, indirect expenses. So we mentioned the 500 in the indirect expenses. So one statement, even this type of statement is really an important statement, plus it is one of the favorite statements of IGCSE and A levels examiners. So they normally ask you that 1500 was or any amount related to that. Or let's suppose if I gave you an example of 1500 was spent. Out of that 1500, 1000 was related to the capital expenditure, 500 was related to the revenue expenditure. So actually he's trying to see that how you are going to treat this single statement. You don't need to get confused. Just split up, distinguish between the capital expenditure and revenue expenditure, and then whatever the part of capital expenditure is, put it in the head, that is statement of financial position, over here in this example machinery account, and the repairs and maintenance under the indirect expenses. So, but an important element over there is wrong treatment of capital or revenue expenditure leads to error in both income statement and statement of financial position. How it is happening? Like, let's suppose if you put all 1500 in the capital expenditure, that means you are putting all of the amount in statement of financial position, and by this way you are trying to ignore the expense of 500. So if you ignore the expense of 500, that means you are increasing the profit, is it? So in the income statement, if you are not mentioning any expense, that means you are indirectly increasing the amount of the profit. That is a misstatement. So similarly, by just one mistreatment or a wrong treatment will lead to two errors. One error on the statement of financial position and second error in the income statement. And this type of error cannot be found out using the trial balance, because the journal entry is right, but at the back end of the journal entry you are making it a wrong entry. So that was the first part of the video lecture. If you want to continue talking about the capital receipt and revenue receipt, just click on the video which is mentioned over there, or you can find the link of the video in the video description as well. Why I'm splitting this video in two parts, that you first try to practice on capital expenditure and revenue expenditure. Once you are 100% clear about that concept, by doing some of the exercise questions related to that, once you are very much clear about the capital expenditure and revenue expenditure, then after this move on to the second part of the video, which is capital receipt versus revenue receipt. Else you may get confused, because these are quite an interrelated terms. So thank you very much for the first part. In the next part we will discuss about the capital receipt versus the revenue receipt.